For years, a silent agreement existed between the digital nomad, the weekend freelancer, and the casual online seller that the small streams of income flowing through apps like Venmo or Zelle were invisible to the watchful eyes of the government. This collective illusion created a sense of financial sanctuary where one could build a side hustle or sell personal belongings without the immediate shadow of tax forms looming over every transaction. We lived in an era where digital handshakes felt as private as cash exchanged in a dark alleyway, leading many to believe that as long as they stayed under the radar of traditional banking systems, their micro-earnings remained their own little secret. However, that veil of digital anonymity is being systematically dismantled by the Internal Revenue Service as they implement a massive shift in how they view the gig economy and its participants. The sudden drop from the previous $20,000 reporting threshold down to a mere $600 represents more than just a change in policy. It is the closing of a massive loophole that once allowed billions of dollars to circulate outside the formal tax net. Imagine the shock of receiving an official tax document for doing nothing more than selling a used camera or walking a neighbor's dog a few times throughout the year. This new reality raises a chilling question that every modern worker must now confront. Could a handful of seemingly insignificant digital payments actually be the very thing that triggers an audit from the most powerful financial institution on the planet? We are entering an age where the boundary between personal life and taxable business is blurring into non-existence, forcing us to ask if we are prepared for the absolute transparency that the digital age now demands. The Internal Revenue Service estimates that the United States loses hundreds of billions of dollars every single year due to what economists call the tax gap, which is the difference between taxes owed and taxes actually paid on time. This staggering deficit, often exceeding $600 billion annually, has forced federal agencies to look beyond traditional corporate payrolls and toward the exploding gig economy where peer-to-peer payment platforms have become the primary veins of commerce for millions of Americans. By lowering the reporting threshold to $600, the government is not necessarily looking to bankrupt the casual freelancer, but is instead attempting to map out a massive shadow economy that has operated in the dark for far too long. This policy shift signifies a fundamental change in how the state monitors the flow of capital, moving from a system of trust to a system of total data immersion, where every digital footprint is a potential line item on a federal balance sheet that must be accounted for by the end of the fiscal year. At the heart of this resistance to tax reporting is a deep-seated psychological phenomenon regarding how we perceive digital currency compared to traditional wages. When a person receives a notification on their phone that they have been paid via Venmo or Zelle, the brain often treats that balance as play money or a digital gift rather than hard-earned, taxable revenue that requires formal accounting. This mental accounting bias creates a dangerous disconnect where the ease of the transaction masks the legal reality of the income, leading many to spend that digital balance instantly on consumer goods without ever setting aside a portion for the inevitable tax bill. We have become addicted to the frictionless nature of these apps, finding comfort in the speed of the send button while completely ignoring the fact that these platforms are now legally required to act as informants for the Department of the Treasury. This lack of friction removes the psychological weight of earning money, making the eventual tax obligation feel like an unfair penalty rather than a predictable cost of doing business in a modern society. This evolution of the financial landscape is driven by the rapid expansion of the gig economy, a sector that has grown so fast that it initially outpaced the ability of regulators to effectively capture its true value. For years, the lack of oversight acted as a powerful incentive for people to leave traditional 9-to-5 jobs in favor of the flexibility found in freelance work or small-scale online entrepreneurship. However, the very technology that provided this freedom is now being repurposed as a sophisticated monitoring tool to ensure that every dollar earned from a side hustle contributes to the national treasury. The era of the off-the-books digital side hustle is coming to an end as the IRS leverages advanced data analytics to cross-reference these $600 thresholds against reported income, leaving no room for the casual errors that were once common in the pre-digital era. The system is designed to close the gap by making transparency the default setting for every person participating in the modern American workforce, regardless of their employment status. The underlying motivation for this aggressive enforcement is the realization that the cumulative total of millions of small transactions far outweighs the tax revenue generated by a handful of large corporations. By casting a wider net with a much smaller mesh, the government ensures that it can capture even the smallest fragments of economic activity that previously slipped through the cracks of the financial system. This transition represents a significant psychological burden for the average worker who must now transform from a simple service provider into a meticulous record keeper overnight to avoid potential legal complications. As the reality of this new oversight begins to sink in, we must ask ourselves if we are prepared to navigate the complex mathematical traps that lie ahead when the automated systems of the IRS start generating those dreaded 1099-K forms for every digital dollar we earn. Understanding the mechanics of these forms is the first step in surviving this new era of digital fiscal responsibility as we shift from the theory of digital convenience into the hard math of financial reality. The 1099-K form serves as a blunt instrument of data collection that records every cent of gross payment volume regardless of the actual profit margin involved in the transaction. When the $600 threshold is crossed, the payment processor is legally obligated to report that total number directly to the federal government, creating a permanent digital record that the IRS computer systems will automatically cross-reference with your individual tax return. This means that if you receive $601 in total payments for goods or services but fail to report it on your annual filing, a red flag is immediately generated in an automated system designed to identify discrepancies with surgical precision. The math here is cold and uncompromising because the government starts with the assumption that every dollar reported on that form is pure, taxable income, placing the entire burden of proof on the individual to demonstrate otherwise through meticulous documentation. To survive this new mechanical reality, one must master the fundamental equation of net profit versus gross revenue, which is often the difference between financial stability and a crushing tax debt at the end of the year. Many casual sellers fail to realize that the gross amount shown on their Venmo history is not the amount they will actually be taxed on if they understand how to apply the mechanics of legitimate business deductions. If a freelance graphic designer receives $1,000 for a project but spends $400 on software subscriptions and hardware depreciation, their taxable exposure is reduced to only $600. This simple subtraction is the most powerful tool in the arsenal of a taxpayer, yet it requires a level of organizational discipline that most people have never had to exercise before the implementation of these new reporting rules. Furthermore, the mechanics of this reporting change create a specific trap for those who use digital apps to sell personal items at a loss, such as an old sofa or a used bicycle from their garage. Under the current guidelines provided by the Internal Revenue Service, selling a personal item for less than you originally paid for it does not result in taxable income, yet the payment app will still issue a form if the total transactions exceed the $600 mark. This creates a confusing mathematical scenario where a taxpayer might receive a form for $800 that represents a financial loss rather than a gain, necessitating a sophisticated understanding of how to report these non-taxable events to avoid overpaying the government. The math of the new tax era demands that we stop looking at our payment apps as simple digital wallets and start viewing them as complex ledgers where every entry must be categorized with the precision of a professional accountant. Ultimately, mastering these mechanics is the only way to turn the tide from being a victim of the system to becoming a strategic operator who understands how capital flows and where it is taxed. When you reach a level of scale where your systems are automated and your expenses are tracked with total accuracy, the fear of the $600 threshold vanishes because you are no longer guessing about your financial health. You begin to see the power of the system not as a barrier, but as a framework for building a legitimate enterprise that can eventually leverage the same tax codes used by the wealthiest individuals and corporations in the country. This transition from chaos to calculation is the essential mechanical shift required to move from the anxiety of being tracked to the confidence of being a professional in an increasingly transparent global economy. The psychological weight of living in the shadows of the financial system creates a persistent state of low-level anxiety that actively prevents the accumulation of true wealth. When a freelancer spends their mental energy calculating how to split a $700 payment into two smaller transactions to avoid a digital paper trail, they are engaging in a zero-sum game that yields no long-term return on investment. This scarcity mindset is a self-imposed ceiling because it prioritizes the retention of a few tax dollars over the expansion of a professional reputation and the ability to access institutional capital. Real wealth is built on the foundation of absolute transparency because the modern global economy is designed to reward those who can prove their income with verifiable data points rather than those who operate in the murky fringes of the unrecorded cash economy. Transitioning from a casual side hustler to a legitimate business owner requires a radical shift in how one perceives the cost of doing business within a strictly regulated environment. Many people view the Internal Revenue Service as a predatory entity looking to steal their hard-earned money, but a strategic mind sees the tax code as a roadmap for optimizing operations and securing future leverage. By embracing the $600 threshold and maintaining a clean financial record as recommended by major financial institutions like Vanguard and Fidelity, an individual gains the ability to apply for a mortgage or secure a low-interest business loan. The hidden cost of staying under the radar is the loss of access to the very tools that allow the wealthy to multiply their assets through the power of other people's money and institutional trust. We must also consider the immense opportunity cost associated with the manual labor of financial evasion, which often consumes the most valuable resource any entrepreneur possesses, which is their time. If a person spends 10 hours a month meticulously managing various payment apps to hide $3,000 of annual income, they are essentially valuing their professional time at a rate that is likely lower than the federal minimum wage. A strategic thinker recognizes that their energy is better spent building a high-value skill or refining a product that can generate 10 times that amount in legitimate, scalable revenue that can be invested in the S&P 500 for long-term growth. The true difference in the mindset of wealth is the understanding that paying a fair percentage in taxes is a small price to pay for the freedom to operate at a scale where the upside is virtually limitless. Furthermore, the shift from a scarcity mindset to a strategic one involves re-evaluating the concept of freedom itself as something that is purchased with compliance rather than stolen through avoidance. When you operate within the light of the legal system, you no longer have to fear the sudden arrival of a certified letter from the Department of the Treasury or the freezing of a bank account that could derail years of progress. This peace of mind acts as a cognitive multiplier, allowing the brain to focus on innovation and long-term planning instead of short-term survival tactics that offer no sustainable path to financial independence. The modern professional understands that the government is essentially a silent partner in every enterprise, and once you accept this reality, you can begin to use the rules of the game to your advantage instead of being crushed by them. Ultimately, the decision to step out of the shadows and embrace a professional financial identity is the moment a side hustle transforms into a career with the potential for generational impact. This evolution requires a person to look beyond the immediate pain of a tax bill and see the long-term value of a clean balance sheet that serves as a passport to the higher tiers of the economic world. It is the difference between being a laborer who is paid for their time and an owner who is rewarded for the systems they have built and the transparency they provide to the market. By choosing to play the game at the highest level of integrity, you are not just complying with a new reporting threshold, but you are actively signaling to the world that you are a serious player who is ready for the responsibilities and rewards of true financial success. The first and most critical action you must take immediately is the absolute separation of your personal finances from your business activities by opening a dedicated bank account for your side hustle. When you mix your grocery money with your freelance earnings in a single account, you create a forensic nightmare that makes it nearly impossible to defend your deductions during a potential inquiry from the Internal Revenue Service. By funneling every business-related payment through a specific portal, you are essentially building a firewall that protects your personal assets and provides a clear, undeniable trail of your professional economic activity. This simple structural change transforms your chaotic digital wallet into a legitimate business ledger, allowing you to see exactly how much you are earning and, more importantly, how much you are actually keeping after expenses are accounted for in real time. Once your accounts are separated, you must implement a rigorous system for digital record keeping that captures every receipt and invoice related to your income-producing activities throughout the fiscal year. Modern tools and mobile applications allow you to photograph and categorize expenses the moment they occur, ensuring that you never lose a valuable tax deduction due to a faded paper receipt or a forgotten transaction. This habit of continuous documentation is the only way to effectively lower your taxable income because the government only allows you to subtract costs that you can prove with a verifiable paper trail or digital equivalent. By treating every business purchase as a strategic move to reduce your tax liability, you shift from being a passive recipient of a 1099-K form to an active manager of your financial destiny who is prepared for any level of scrutiny from federal regulators. Finally, you must develop a protocol for handling non-taxable transactions like reimbursements or personal gifts that might accidentally trigger the $600 threshold on platforms like Venmo or Zelle. Whenever you receive a payment that is not earned income, you should clearly label the transaction within the app and maintain a brief internal note explaining the nature of the transfer to differentiate it from business revenue. When the end of the year arrives and you receive your tax forms, you will be equipped with the precise data needed to accurately report your gross receipts while excluding non-business items on your Schedule C or other relevant tax schedules. This proactive approach ensures that you only pay taxes on your actual profits, effectively shielding your personal life from the broadnet cast by the new reporting requirements while maintaining total compliance with federal law and securing your long-term financial health. The most dangerous trap in the entire landscape of the modern gig economy is not the complexity of the tax code or the persistence of federal regulators, but rather the insidious psychological pull of lifestyle lamfat that often follows the deceptive ease of digital payments. When you receive money instantly through an app on your smartphone, it is incredibly tempting to view that balance as a source of immediate gratification rather than a strategic asset that must be protected and reinvested into your future self. This cycle of earning and burning creates a financial treadmill where even a significant increase in gross revenue fails to result in a higher net worth because your consumption habits automatically expand to consume every new dollar you generate. You must resist the urge to treat every notification from Venmo or Zelle as a signal to purchase temporary luxuries and instead recognize that these funds are the raw material for the capital machine that will eventually grant you true autonomy in a world of rising costs and economic volatility. Another critical trap that often ensnares the unwary freelancer is the false sense of security that comes after the initial fear of the $600 threshold begins to fade and the routine of daily work takes over. Many individuals fall back into the dangerous habit of commingling funds or failing to document their minor expenses, mistakenly believing that their small scale of operation makes them invisible to the massive data processing capabilities of the modern Internal Revenue Service. This complacency is exactly what leads to the most painful and expensive audits because it leaves you completely defenseless when the automated systems of the government finally identify a discrepancy that has been compounding over several fiscal years. True financial security is not found in the momentary cleverness of your evasion tactics, but in the boring, repetitive, and disciplined consistency of your record keeping and your absolute adherence to the established rules of the financial game that the wealthy have played for centuries. We must now return to the image from the very beginning of this journey, where we once believed that our digital handshakes were private and our small side earnings were hidden in a secret sanctuary of anonymity. We can now clearly see that this sanctuary was a hollow illusion that kept us small and fearful, tethering our professional potential to the shadows rather than allowing our ambitions to grow in the full light of the global market. By embracing the transparency demanded by these new reporting rules, you are not surrendering your freedom to the state, but are instead trading a false sense of privacy for the very real power of being unauditable and financially professional. You have successfully transitioned from a person who is constantly looking over their shoulder in fear of a letter from the Department of the Treasury to a person who can stand confidently in front of any bank or institution and prove exactly what they are worth with verifiable data. The path forward requires a constant and unwavering vigilance against the temptation to return to the chaotic and unorganized habits of the past, and a deep commitment to the strategic mindset that views every single dollar as a potential tool for future leverage. As the digital economy continues to evolve with even more sophisticated monitoring tools, those who master the mechanics of reporting and the psychology of self-discipline will be the ones who thrive, while the rest are caught in the widening mesh of the government's net. Your financial legacy will not be defined by the small amount of taxes you managed to avoid through secrecy, but by the robust systems you built and the clarity with which you managed your journey from a simple freelancer to a sophisticated architect of your own financial destiny. Remember that in the age of total transparency, the most valuable asset you can possibly possess is a clean ledger and the profound peace of mind that comes with knowing you have nothing to hide and everything to gain. The digital ink on your 1099-K form is not a death sentence for your business, but a birth certificate for your professional identity. In a world where every transaction is tracked and every dollar is documented, the only way to remain truly free is to be flawlessly prepared for the light of scrutiny. The era of the digital shadow is officially over, and the era of the transparent empire has finally begun for those brave enough to lead it.